Hello everybody, this is AK. I'm back. So recently I made a video with the title DBS and OCBC are better than UOB question mark exclamation mark and sell UOB now question mark exclamation mark. That was a video made after comparing the three banks. And I said that OCBC was the strongest bank in terms of CET1 ratio at almost 16%, 15.9% to be exact. And I said UOB peers in comparison with less than 14%, lower than 14%. And I said that DBS had the highest ROE and also the highest dividend yield. At that time, the bonus issue, it was still bonus issue. So if we bought it at the time, we would still be eligible for the bonus issue, 1 for 10. And so I said, comparing to DBS looked to be more attractive for the income investor. So I said, what to do? And if you are new to investing and you're thinking of investing in the banks, you haven't had a stake yet, you might well think, hey, then why invest in UOB? I should invest in DBS and OCBC, and UOB can wait, right? So I made a case for investing in UOB because UOB seemed to be a safer bank from another angle, and that's the angle of exposure to China. How it probably has the lowest exposure amongst the three banks to China, and China we know is having some problems. Biggest problem being is troubled property sector, which accounts for almost 30% of its economy, and it's melting. It's not melting down; it's already melted down. And DBS and OCBC have like a 30% exposure to China, right? So I say even though UOB doesn't have the highest yield, even though it doesn't have the highest CET1 ratio, there is a case for investing in UOB. And I referred to a video I made some time ago about how UOB was set for growth, and we should invest in UOB with an eye on its future growth, right? And of course, if you have been following my blogs and my videos, you know that I first bought into UOB significantly during the pandemic at about $19 per share. Before that, I only had exposure to DBS and OCBC. So maybe the video that say DBS or OCBC are better than UOB, it's me talking about myself in the past. Yeah, so I wanted exposure to all three banks, right? So I got into UOB when the share price crashed during the pandemic. I'm making it one of my largest investments back then, and still one of my largest investments now. I added significantly to my investment back in like October 2022 at around $26 a share, when there was some pessimism, and $26 seemed to be like the bottom, or at least an important floor looking at the charts at the time. So I bought in about $26 per share, and that bumped up my stake in the bank quite a bit. And the most recent purchase was, I think, made in 2023, if I remember correctly, at about 27 something per share, right? So and I think I made videos about all my purchases before, so if you're interested, you can watch some of my older videos, and I'll leave links to the two videos I mentioned in the description box below. And today I read a DBS research report that has actually upgraded UOB to a buy. They said to hold UOB before, but now they say buy UOB. And I would like to share the reasons with viewers here why DBS says buy UOB. And before that, the important thing that most people want to look out for, target price. DBS now has a higher target price of $34.50 per share for UOB. Wow. Okay, remember what I said before about target prices. Their target prices, is just to get eyeballs, it gets people excited, it gets people's attention. That's all. Okay, now let's look at the reason why DBS thinks that UOB is a buy now, right? First, they say active management of deposit costs, right? They say while fourth quarter 2023 net interest margin saw a sharper quarter-on-quarter contraction on loan yields due to competition for high-quality credit, UOB actively managed deposit costs, and this will buffer its earnings going forward, right? So we know it has been actively managing its deposit costs, especially if you have a UOB One account. They're cutting interest rates, right, that we get on our savings, right? So it'll be a maximum of 4% from May onwards instead of 5%, right? In total, right? And that 4% interest, maximum interest that you get on your savings is only if you have $150,000 in the UOB One account, whereas now $100,000 in your UOB One account can potentially get you 5% interest on, right? So they actively manage deposit costs, and we know for the longest time that UOB has been very giam-siap, very stingy with their fixed deposits, the interest rates on their fixed deposits. Okay, so the DBS also say that UOB continues to lead the market in cutting retail fixed deposits since the second half of 2023. So they are the leader when it comes to cutting interest rates for fixed deposits in our savings. Okay, the second reason DBS says to buy UOB is that there will be fewer or no rate cuts in this year 2024, right? So already, because I said in the previous video that inflation is much higher than expected, it's not coming down as quickly as expected in 2024, so we might not see the Fed cutting interest rates this year. If they do cut, it'll be much later in the year and there'll be fewer cuts, right? So this is what DBS provides as a second reason for buying UOB. So if there is no rate cuts or fewer rate cuts or rate cuts of lower magnitude, that will support net interest margin, net interest income for all banks, not just UOB. The third reason is asset quality continues to remain stable thus far. Right, so UOB has very little exposure to China, the troubled Chinese economy, like I said, and their asset quality continues to remain stable thus far. Right, however, they do have an exposure over Hong Kong office or commercial real estate, and that is something all of us should be cognizant of. Hong Kong, of course, is in a bad place. The economy is not doing well. And of course, if you have been reading the news, you know that like more than 200 bankers in Hong Kong have been retrenched in 2023, and there'll be more retrenchment in 2024. And partly because their pay is so much higher than bankers in Singapore, for example, it's like 40 to 70% higher, and their investment bankers in Hong Kong can be paid like 100% higher than what investment bankers are paid in Singapore. It's mind-boggling, right? So, and shrinking workforce in Hong Kong, less requirement for office space, or people require smaller office spaces, and of course there are many multinationals which have downsized or left China, and that includes Hong Kong. So UOB does have exposure to Hong Kong office commercial real estate, and the vacancy rate has risen, and DBS and OCBC have an exposure of 4.3% and 2.3% respectively, and UOB Greater China exposure is less than that of its peers, but it still has a 1.3% exposure to Hong Kong commercial real estate in the loan book, right? So minimal impact, but there might be an impact there. So, but like I said, DBS thing is negligible. The asset quality continues to remain stable thus far. And the fourth reason for investing in UOB is valuation continues to be undemanding. right? That's what I kept saying in recent videos, that if you haven't gotten our foot in the door yet, investing in the local banks, investing at higher prices now isn't a bad idea. We also be investing in good businesses at fair prices. So valuations are still fairly undemanding, even though stock prices have gone up, right? And they say UOB is currently trading at about 1 times book to 1 times price to book. And they also believe that first quarter 2024 net profit likely continue to improve, right, due to improving net interest income, due to improving deposit costs. You'll be paying us savers a lot less, as well as higher non-interest income. Like I also said in the past, net interest income isn't the bank's only source of income, right? And so that's DBS take on UOB and why we should think of investing in UOB and staying invested in UOB. So if AK can read the news, so can you. Bye bye.